organization restructuring meant that we have industry veterans at the front end, people who've been here in Crompton for years and years. And at the back end, we have a whole bunch of domain experts who now come in and significantly bolster that area. And sorry guys, you still can't hear me? If you want, I'll move up a little bit closer.
Sir, there is still a slight bit of crack in your voice. So I think you can try moving closer to the mic, or we can try switching off the video.
No, we're just coming closer to the mic. Just tell us now.
My face is better than my voice, so don't switch off the video. Is this better?
Yes, much better, sir.
Okay. All right. So, so we've got now our senior leadership team is fully in place, but with empowered organization also comes accountability, and I think that is at the core of how we see this entire team driving and transforming Crompton into what its rightful position is, and deliver a growth-oriented organization and strong case studies years to come. Okay, so let's go to the next stage. A quick update on some of the key steps on Crompton 2.2 that have since been initiated. One, we continue on our premiumization journey. We saw strong growth in the premium ceiling fans category. Saliency of premium fans has since improved to about 28%. There's a new brand architecture in pumps, which we've talked about in the past, particularly in the mini segment, and we have rolled out a new brand architecture. While we have our largest selling mini at the center of it, we also have premium pumps that we're selling and will improve the kind of realization that we're getting. In the kitchen segment, our focus is being to have a differentiated portfolio with superior and industry-first features based on extensive consumer research and insights. For instance, we introduced chimneys with significantly reduced sound decibel levels and a super slim hobs for consumers so that they do not have to cut their slack. Now, insofar as go-to-market is concerned, I'm just briefly touching on them so that, we can, if someone wants, we can get into it in greater detail later. But very briefly, we have been focusing considerably on building out our alternate channels. So we've historically been very strong in what's called general trade, but we've also put a lot of emphasis on alternate channels, materially contributing to growth going forward, and that has grown 32%, as you can see. Now, alternate channels includes e-commerce, urban, etc. Now, particularly e-commerce, for instance, is consistently grown, and in Q1 grew at about 44%. We've also been working on expanding our reach in smart domestic appliances, also called kitchen appliances, as well as our B2C lighting. Particularly in lighting, we have significantly expanded our reach by adding several new distributors in untapped markets, with the addition of more feet on street. We have also built upon our urban channel and our e-commerce channel by introducing new products and apps. For small domestic appliances, the infrastructure set up is nearly complete, particularly in the north and the south. Again, we added distributors and appointed FOS. And together with all of this, we've been working on in-store visibility, leading to retail transformation. Brand investments, we spoke of this quite a bit, and that as we transform the company to be demand growth led, investing in the brand is a critical thing that we intend to do. So you can see significantly stepped up A&P spends, which have gone up about 4.2% in quarter gone by. You're likely to be seeing this elevated levels because we see this as having a huge impact on the uptake of our products in the months and quarters ahead. Similarly, and we'll talk a little bit about this later, some of the marketing campaigns that have been rolled out, and these have all a high share of voice for our product. Insofar as innovation is concerned, we have introduced 7 new products. In fact, I already mentioned that we have arguably the largest range of BLDC, particularly ones which have been built ground up. We've added variants under the mini series in the pumps category, and we've launched new variants in our water heaters range to add to especially focused on the e-commerce. For a quick update on Butterfly, I provide an overview here, and we can discuss this again in greater detail later. But in this particular, we have, as you already know, we do a strategic reorientation of our channel mix by emphasizing retail, modern trade, and optimizing e-commerce while de-risking the corporate and the non-core channels. In Butterfly, our core channels are now performing quite well. We are in the process of merging Butterfly with Crompton, and we have the opportunity to start realizing go-to-market synergy apart from cost synergies. And the go-to-market synergies will improve Butterfly's reach, particularly initially in the western and northern markets. And this is called the Power of One. And we see this paying off in the next few quarters. We've expanded our portfolio, again, made brand investments, also in Butterfly, where A&P levels are at 5.4%, and launched several above the line and below the line activities. We've expanded our portfolio to cooking, in food processing, and the cookware range. And finally, insofar as our integration is concerned, that's underway, and we expect that to be completed by the end of this financial year. You'll probably, we have informed the stock exchanges earlier that we have now received approval from both the LSE and the BSE, which have enabled us to go ahead to the filings with the NCLT for the merger. Right? Now, next page. Macro looking like? Broadly, I'd say we did not get a lot of help from the macro environment over the last quarter. It's continued to be relatively challenging, but we've worked relentlessly to deliver strong results, despite driving inflation, leading to subdued consumer sentiment and overall softness in demand. Unseasonal rains did not particularly help, and regulatory changes further added to the volatile demand environment, which impacted channel inventory and suppressing actions. With inflation at 4.8% in June 23, the overall consumer buying index in consumer durable segment has so far remained soft. These pressures impacted overall margin, but the efforts on premiumization, mix improvement, and cost optimization have partially offset the impact. After a slowdown in April and May 2023, the demand, however, seems to be picking up from June, and we hope that that trend will continue in the months to come. Going forward, we expect price mix contribution as we are positioned to deliver improved, hopefully improved conditions over the next half of the year. Now, next specifically getting on to the quarter. Again, I'll leave it. I'll not read out what we're saying in the presentation because I think that's read, but just basically just call out a few of the highlights. ECD revenue grew by 6% despite a challenging environment, particularly strengthened by strong growth in our appliances segments. For the actions that we took on our lighting portfolio helped improve our margins by as much as 300 basis points. We believe that this is going to bolster our lighting's fit for growth, position as we have over this period of focused on changes in our go-to-market structure. In Butterfly, as I mentioned, we focused towards retail and modern retail channels by reducing e-commerce. It's important to note that we've significantly stepped up E&P spends, which will, while investing in our brands, which we expect will pay off in the future. And I have, as I said, the organization structure is in place. Our new built-up kitchen appliances business is so far shaping up well. It is small, and we're obviously investing materially in this business so far, but so far the indications are positive. Next page. These are the consolidated financials. You must have seen this already. ECD margins, EBIT margins to 12.7%. But the ECD margins notably include 7 crore EBIT loss that the kitchen appliances business is currently incurring, and we see that as an investment for the future. As for the lighting segment, EBIT margin improved 2%, and that is despite the revenue decline of 13%. And this is on the strength of various cost initiatives. The Butterfly segment we'll talk about in a short while. Now, on the ECD segment, fans brought the volume value growth about 5%. Q1 saw strong momentum in ceiling fans and TPW fans. The 5% growth in the fans category was led by improved saliency of premium segments, which I've spoken about already, as well as strong growth in the TPW. Another segment that we focused on, as I mentioned earlier, is the BLDC segment, which grew 80+% in the last quarter, and quite of about 3 lakh plus, very broadly speaking, BLDC fans were sold in the last quarter. Our media campaign, star-rated fans, active BLDC have resulted in good momentum and high share of voice. We've collaborated with as many as 14 digital influencers to drive discoverability and high views. Going forward, we plan to add more decorative offerings in the BLDC range, and we recently launched BLDC Baby Enso, which is a smart BLDC fan with energy savings. And needless to say, we have another in BLDC fans so far. Not so far already. Okay, apart from BLDC fans, like I said, the TPW segment is also growing quite well. Next, coming to pumps. flat, flat segment this quarter. We continued the action that we took in Q4 in FY2023 to bring our pumps business back on track. We rolled out a brand awareness program for the mini pump segment to communicate essentially a laddering based on faster tank filling as well as greater durability. That has helped contribute to a sharp differentiation from me-too product, which earlier were making some headway and no longer are. We have also undertook strategic pricing actions to ensure that the price premium is at the level which the consumer is willing to pay for. The pumps, the value growth, which I will say is relatively flat. It has some weakness in the north because of increased competitive intensity. While the eastern region, which is the other large pumps region for us, is getting back on track. And we are currently working on significantly strengthening our northern market. And we are also simultaneously seeing promising signs of growth in our agri segments. Guys, you still can't hear me?
Just take a video for production for some time and you tested it. Okay.
All right. Okay. Appliances, strong growth this category. And we spoke about this earlier. This is also a segment that we've actually split into two. One being the large domestic appliances, the other as the small domestic appliances, LDA and SDA, are the references to these segments that you're going to see going forward. Now, this obviously did not particularly impact the last quarter, which the original structure was still in place. But importantly, the small domestic appliances, particularly mixer grinder, grew by 50% plus, while the water heaters and the air coolers business grew about 11%. And the large domestic appliances now also fall under the broader fans category and form the electrical segment for us. Okay. Then infrastructure setup is nearing completion, and there have been appointments of 320 distributors with Street, which has contributed to particularly the growth in the small domestic appliances market. In our media campaigns for air coolers was well received, and they resulted in high share of voice. Particularly in storage water heater, we started supplying products which meet the new BEE criteria. And in instant water heaters, we launched two SKUs in June 23, namely Solarium Neo 5 liters and Rapid Jet 5 liters. Built-in kitchen appliances revenue stood at about 10 crores, led by good momentum in chimneys and knobs. Significant efforts are made to develop the channel. There are cumulative 54 brand stores, which combine signature stores as well as exclusive stores, which now have our kitchen appliances range and have been opened across 20 city clusters. And our reach is now in 260 outlets. Lead generation campaign and performance marketing is generating quality leads at a good conversion rate. We continue to invest in building the business by creating brand awareness and building up capabilities as an indicator of this, as I said earlier. This business is currently making the loss of 7 crores in the last quarter. And either we have Lighting, in lighting, we struggled in the past and from in many initiatives that we are taking to turn around the lighting business is that the lighting B2C sales has been carved out. It was a part of the overall sales organization earlier, and now specifically folds into lighting B2C sales head who folds in directly into the lighting business unit head. We believe that that clear carving out and focus at the sales level will help our go-to-market in lighting. Insofar as the other elements of our GTM restructuring are concerned, we are strengthening our dealer network with range addition, and we will be expanding and driving our outdoor range in lighting. We are also driving premiumization. You may be aware we introduced a trio range of products, and that property will further be developed in this quarter with more launches in that segment. We've also launched innovative solutions and have entered new categories like room lighting, table lamps, and night lamps, etc., all with the objective of broadening our offering to the market. Softness in the lighting B2C demand was also not unique to us, and I think you must have seen that this is also something that impacted other industry players. And this is because of a combination of price rationalization and increased competitiveness. For the pricing reductions, particularly in the bulbs and batten range, also impacts volumes because it leads to lower channel stocking. Next, reported this performance earlier, but I'll quickly take you through the highlights of this. Revenue was at 219 crores, which is down 14% due to double-digit growth in the B2C channels. But while we did channel rebalancing, the overall number was about almost 14% lower than last year. Material margins stood at 42%. There's an expansion of 65 basis points year on year. Significant improvement in material margins driven by improvement in retail mix, operating efficiencies, and cost optimization. The company continued its efforts towards building capabilities across functions such as sales, marketing, operations, and R&D. And the 9% EBITDA margin that you see is post the investments both in marketing as well as in people capabilities. We are continuing our efforts in building our people capabilities apart from strengthening processes and compliance, which has resulted in lower attrition and fewer safety-related and better safety-related performance. Marketing campaigns, that's the next page. Yeah. This is a glimpse of various marketing campaigns that we've rolled out. I will not take you through all of them. I'm sure you're quite aware of many of these. But the idea essentially is that we are investing both in demand generation by stepping up our thinking and retail activities, as well as by strengthening the go-to-market in previously untapped areas like rural and e-commerce. And these we hope and believe will begin to pay off in the coming days. Okay. Very roughly, our A&P spends at Crompton level were higher versus at about 4.5% versus the 3% that they were in quarter one in FY2023. That's about 1.5% higher. Okay, next page. Oh, sorry, one second. All right, we can get into consolidated financial performance. Kalish, you can talk through this later in greater detail, but I'll just hit the high points. Revenue from operations to net for 1877 crores, remaining flat YOY. PCB growth was at 6%, soft demand for lighting and butterfly. Material margins at 30.8% was mostly due to higher BEE costs in fans and price correction in bulbs. This was positively offset by improvement in margins in lighting and appliances as well as a rebound in trade for butterfly. EBIT margin was about 10% on account of higher A&P spends. PAT margin remains flat at 6.5%. We continue to have negative working capital and have generated robust cash flows from operations. Consolidated cash and cash equivalents at the end of the quarter was 783 crores. This compares with 657 crores that we had as of 31st of March 2023. Now, finally, you're going to see my face again. That's to distract you from this page. I hope you don't get distracted too much. All right, so finally, key positive development in the organization as we look to the future is to accelerate growth at healthy margins and deliver strong TSRs for our shareholders. Right? So, as we become a more growth-oriented organization, I believe the stands that we are taking at our various aims at the various elements that you've already seen will lead to value creation for our stakeholders. We will protect and grow our core categories of fans, large domestic appliances, and pumps. And will endeavor to win in the kitchen segment. The kitchen segment now comprises the small domestic appliances business of Crompton as well as butterfly. And we expect that to be a key driver of growth going forward. We have identified issues in lighting, and as I said, the improvement on the cost front that we've been able to do in lighting gives us the confidence that lighting business is becoming good for growth as we focus on the GTM and various process enhancements to be able to leverage this cost position. The way I think about the step change towards Crompton 2.0 is first to strengthen and consolidate the backbone of our organization, which begins with creating a center of innovation that is intrinsically led by consumer needs. Now, you know, when we've got about 160 people at our innovation center at Vikhroli. We have one more actually R&D center in Butterfly as well. There's and a significant amount of money and investment going into that. Some of which the benefits of which are already being seen, but it's still early days yet in the kind of benefit we believe the innovation will help us drive. Okay, we will foray into new segments, and we expect to enter about maybe 2 to 3 wide spaces in the next, next 3 or 4 years. And that effectively will be areas that we believe we have a right to win in, and areas that we can become leaders if over a period of time. Okay. At the same time, we are also developing strategic long-term manufacturing and supply chain footprints, which will support and enable emboldened ambitions. In conclusion, I'd say, although we are structurally stronger today, we have been in the midst of a rough macroeconomic environment, with the industry facing some near-term challenges as the broader consumer sentiment is still cautious. Therefore, while the journey of Crompton in H1 FY24 is expected to be a bit bumpy, we expect that the situation will continue to improve, and we're seeing some early signs of that towards the end of this fiscal. And we continue to work tirelessly to strengthen our competitive position and simultaneously identify new avenues of growth, which I don't need to reassure you about. I know this already, but our newer initiatives will be unveiled as we go along. And finally, I'm confident of strong fundamentals of the underlying business, and my belief in the future growth trajectory remains strong. Thank you for your patient listening, and now we will be open to Q&A. I wish particularly if you please step in for any comments. Shantanu, you want to say something? You are thinking about that. Why do you come here, Shantanu? You will not be otherwise heard like that. Yep.
Over to you, Kunal.
Oh, sure. So we are starting the Q&A session. Ladies and gentlemen, for anyone to ask question, please use the hand raise feature. And once you will join the queue, and once your name is announced, and you will be unmuted, and you can go ahead and ask the question. So anybody who wants to ask the question, please raise your hand. So the first question is from Anirudh Joshi Isaac. Anirudh, please go ahead and ask your question. Anirudh, you are not audible. Yeah.
Is it audible now?
Yeah, it is audible.
Yeah, sir, 2 questions. One, we have said the gross margins have got impacted due to some of the issues in pumps and the higher BEE costs in fans. So do we consider these as one time, or these are in a way structural in nature, and so the gross margins are likely to remain lower than what we had seen it in earlier quarters? So that is question number 1. How much is structural and how much is one-time impact, and how should we look at margins ahead? Second question is on EBITDA margins. So we have raised the A&P, and I can see in the presentation that we are aiming at higher SOV for many products. So what is the SOM target that we are looking at? Maybe 50 bips market share expansion each year, or maybe 100 bips expansion in market share. So can you please quantify on that? So basically, what is the ROI that we are looking on the additional investment in ad spend? Yeah, that's it from my side. Thank you.
Yeah. So, first to start with, as an organization, we would believe market share is an outcome of various activities that we do. It's not that we want to chase a particular market share and see where we land to do it. But investing in main consumer, having innovative products to take to market, which will drive the revenue growth and in turn will lead to a market share. So it's not that we are chasing a particular number as a market share. It's more about the actions that we want to invest behind on it. Coming back to your other questions in terms of gross margin and EBIT, where do we stand? Starting with gross margin, first and foremost, Butterfly and lighting business have done well. In both the business segments that we have seen gross margin expanding, led by cost initiatives on both the categories. Having said that, in fan, the BEE cost is yet to be baked into pricing in full. And I think as we go into Q2 and Q3, there are opportunities or compelling cases that is presenting in front of us to take those price increases, which will help us to restore the margin as we move forward. Secondly, on pumps, it is more in terms of where do we see the competitive intensity at this point of time. We have started with the brand architecture. The brand architecture has helped us to arrest decline in pumps and get into a growth phase. We're also seeing some of our early decisions on agri is starting to give us good green shoots. We need to see how does that sustain as we move forward. But overall, as the brand architecture expands, the premiumization of pumps will also help us to get the gross margin back. So that's why we are looking at gross margin in a structural way as we look at the forward quarters. Coming into EBIT, this is a called-out strategy where we clearly said that we are going to invest behind our brands, and which means that would entitle into 150 to 200 bps increase on a year-to-year basis on our marketing spends. And we think this is something that we will continue to do, and the evaluation of that will be more in terms of the revenue growth that we want to deliver rather than a specific marketing quarter-led ROIs. Overall, as Praveen said earlier, as an organization, we are now moving towards profit-led than being profitability-led.
Yeah, I just add a few more things here, Kanish. One, insofar as your question was about structural changes, the cost structure has gone up because of BEE. And now the interesting thing is that all the participants in the market obviously are impacted by this. And because of the somewhat weak economic environment, I don't think any of the participants have been able to pass that on. But we really believe that in the quarters to come, they will be passed on. So, and that will help bolster margins going forward. What's the other point we made?
Pumps.
Insofar as the advertising investment is concerned, clearly there's an effort to step that up as we are going to be growth led. Now, on the EBIT level, we are hoping that some of the cost synergies will also start to kick in. Efforts that we are making, but obviously they can't be synchronized. But that's something that again will give us some more good.
Sure. Thank you, Anirudh. We have the next question from Siddharth Bera, HSBC Nomura. Siddharth, you can please go ahead and ask your question.
My first question is on the fan side. So you have indicated a 5% value growth in the quarter. What will be the secondary growth in the quarter in the fans category? And also if you can share the overall growth for pumps and overall appliances in the quarter?
Yeah, for pumps, we delivered a flat growth in terms of the total quarter is concerned. Appliances is close to 19% growth is what we have delivered. Fans, at this point of time, if we have to look at a BEE rated secondary impact that we saw in the industry, our stock was significantly lower to where the industry was concerned in terms of non-rated fans. We would presume our primary and secondary to be in track.
Got it. And if I look at again on the EBIT margins for the ECD segment, I mean, sequentially we have seen a quite a reasonable contraction on the margins. Are you planning to take any price hike? So large part is because of the BEE, as you have indicated. Now, how is the visibility on pricing? By when do you think you can maybe go back to that 15-16% margins which you used to report, and how soon that can it be? If you can just share some thoughts there.
Siddharth, I think fundamentally this is like what we wanted to call it as a Crompton 2.0, where we want the organization to be growth led, right? Now, there are two levers when you're talking about this EBIT. One is what is the kind of price increase or cost reduction that you need to do to improve gross margin, and second is where do you invest? It was always easy to to cut those 200 bits in terms of the marketing spend and get into a business that will have a 14, 15, 16% EBIT, as compared to a business that has a sustainable revenue growth, which we think will create value. So allow us not to comment on a EBIT target or a margin expansion at this point of time. We would like, and we believe that as to revenue growth is probably paramount to us as we speak. Structurally, where would we go? To address your first question, we think on the gross margin, there is probably we are moving towards a compelling case of a price increase. Now, this is not something that you tend to calendarize it because it's a market where you have multiple players in and you need to be competitive to the industry. So as we move forward, the case is much more stronger to where we were in Q4 or Q1. So there would be price intervention that we would make in case of fans. Now, when you do that, when we also talked about premiumization of fans as a portfolio, mix is also going to be an enabler for us to drive our gross margin. A combination of price increases, mix optimization, moving towards premiumization, and continuing to invest behind brand, we think will expand our absolute profits and therefore deliver EPS growth in the long run.
Thank you. We have the next question from Rahul Gajre Haitong. Rahul, please go ahead and ask your question.
The opportunity. I have a couple. Hello, are you able to hear me?
Yes.
Yeah.
Yes, Rahul.
Thanks for the opportunity. Now, I have a couple of questions. Now, I think you just mentioned that I think a mix, product mix is what will ultimately aid profitability. I want to understand, could you discuss what is the share of premium fans in the total fans and how that has moved in the recent past? And also, do you maintain a similar matrix for at company level, you know, across product category? What is it that you classify as premium and the share of that? Because I understand the growth has been impacted at the lower end of the product compared to the higher end of the products. So that's one thing I want to understand from you all on the premium side.
Yeah. So from a fans perspective, if you look at it, our portfolio used to be about, say, somewhere around in late teens as a share of premium. Today, as we speak, 1/4 of our fans business comes from premium segment. And this is aided by multiple launches that has been made, both in induction and in the BLDC segment. And as we talked about, our BLDC strategy has been to build a grounds up portfolio. And that's what we have helped us to probably expand the range, keeping the consumer needs in mind. So this 1/4 of the portfolio has significant headroom to improve as we move forward, which will help us to improve the overall earnings as we look forward. Now, if you look at categories outside fans, probably I'll take lighting as an example and I'll leave it at that. Lighting, if you look at it, one way of premiumizing is looking at the same category and see what more you can do in bulbs and battens. The other opportunity is also look at things like ceiling, which probably has got a unit price which is significantly higher than bulbs and battens, and it has got a margin profile also which is much more stronger as compared to bulbs and battens. So how do we expand our ceiling range? Today our ceiling to our portfolio is about 1/3 as compared to industry, which we would presume is about, say, 45-50%. And that overall will also period of time help us to premiumize the lighting portfolio and help us to improve the margin. Shantanu, anything that you think of us?
No, but very clearly, as Promeet said, there is a strong renewed focus on premiumization across all our categories. Right? That includes also butterfly, where premiumization within the segments we play, pressure cookers, gas stoves, and mixers, is a clear opportunity which the butterfly team has been introducing initiatives for. For example, recently the butterfly team introduced a high-fly, healthier cooking, less oil pressure cooker as a premium. And in terms of the enablers, Praveen talked about which we have strengthened, which we've strengthened the back end, our entire supply chain operation, our innovation operation, as real expertise and center of excellence operating with us, all are going to have this common focus of driving our strategic choice of accelerating premiumization.
Thank you. We have the next question from Ravi from Spark Avendus. Ravi, please unmute and go ahead and ask your question.
Kind of an extension to the previous participant's question with respect to the kind of more towards the BLDC side. So, how do you see the BLDC as a market panning out? What might be the industry average of BLDC out of the total current sales that is happening, and how we are positioned? What is our share of BLDC? And what's the kind of profitability of BLDC fans, given the fact that apart from the conventional players who are there are also few new players who are there in the space like Atomberg, etc. So if you can give your thought process on it over a 2 to 3 year period, it will be really great.
Look, what I'll say is that BLDC is a technology which has some advantages. Induction motors have certain advantages as well. As we look forward, we see both BLDC and induction being a part of the kind of fans that are sold in the future. So neither of them is going away. Now, insofar as our approach to BLDC is concerned, as you've already seen, we have made significant investments in building out our BLDC range. One difference is that we have built out a BLDC range, particularly as a native BLDC, right? So this is a little bit like EVs. And internal combustion engines, right? You have cars which have been retrofitted with EV technology, and there are cars which have been ground up built on the basis of EV technology. We think that for a consumer to truly get the benefit of the technology, you have to do the latter. And while the other may give you some shorter term benefits over a period of time, that's the direction that we will go towards, right? And look, it's an interesting technology, and you will see us do more and more in that area. We are one of the top two, I'd say, in that segment already, but we are just getting started.
Got it. And my second question is with respect to the white spaces that you had mentioned in the presentation that you would like to get into. I mean, kind of logically speaking, there are one or two sizable segments where you can easily get into and grab share. That is the switchgear market, switches market, where you can kind of strengthen your you already have a very strong presence in reach and distribution where you can get into. And then there is this cable segment, which is kind of capital intensive and probably you may try and avoid. So your thought process on getting into these segments or some other segment, if you can.
You would appreciate that
obviously we can't talk about specific segments. There are multiple segments which we can have opportunity, which we're evaluating. In fact, there are different levels of progress in different areas. When we are able to talk about it, you will all be the first to know.
Sure.
The only thing I would mention, since you mentioned that, yes, given our infrastructure, there are a lot of segments which are easy to get into. Our focus is not just to get into a segment, but our focus is going to be to get into a segment in which we can win. And that is not easy.
Got it. Yep. Thanks.
Thank you.
Also said, so far as the direction of the company is concerned, we created a separate vertical called new business initiatives, which is specifically going to be looking at some of these areas. So clearly there is a fair amount of work that is going on to evaluate the various segments.
Sure. Thank you. We'll move to the next question. May I please request all the participants to limit their questions to one, since we have a long queue. The next question is from Latika Chopra, JP Morgan. Latika, please go ahead and ask your question. Latika, your line is not clear. Still lot of disturbance on your line. Can you move to the?
If you want to chat, type your question in the chat. We can address to it if you can. If there is a. And Kunal, if you could get it.
Yes. I'll move to the next question. Thank you, Latika. We have the next question from Aditya Bhartia, Investec. Aditya, please go ahead and ask your question. Aditya? Hi, Aditya.
Can we please move to the next question?
Yeah, sure. We have the next question from Renu Baid, IFL. Renu? Renu?
Renu, you're on mute. Yeah.
I think all our questions have been answered.
Well?
Yeah, Renu, go ahead. You are.
Yeah, thanks for the opportunity. I have one key question around the margins and profitability. Sorry to harp on it again. If you look at 12.7% kind of ECD margins, they have been all-time low, say about 50-60 basis point impact coming in from the large kitchen appliances. So can you help us understand, while there has been comments given, can you broadly help us bridge the gap from this 13.2-13.3% margins to a normalized 17% EBIT margins that we were doing? And in line with the strategy that we have highlighted in terms of focusing more on growth and investing in marketing team, how should we readjust the expectations for EBIT for the ECD segment, given the mix and the end market responses which have been there?
So, first and foremost, Renu, allow us not to give a forward guidance of what we are looking at in terms of EBIT. But we talked about how we're going to look at growth drivers for the business and how we're going to expand the margin. Coming specifically to the bridge that you are seeking in terms of how has that moved, roughly about 50 bps is on account of large kitchen appliances losses that is there. About 150 bps is on account of the higher marketing spends that we have done. And another 150 bps is on account of the gross margin drop that we have seen in ECD. Now this drop is largely basically on account of what we talked on pants, PEE pricing challenges that we had, which I think as we move into Q2, Q3, we would be taking few price increases at appropriate time. Over a period of time, coupled with mix and price, we should be able to get back to the gross margins where we were in ECD. And coming specifically to on EBIT, I think our higher investments should tantamount into revenue growth for us, which should help us to expand absolute EBIT rather than EBIT margin. And that's a structural change that we need to make. Eventually, we believe value creation for all stakeholders will be through EPS expansion rather than looking at a 17% EBIT margin. Now, as we grow the business and operating leverage kicks in and we reach there, we do reach there. There's no constraint or cap that we are putting on that number. But right now, we want to grow the revenue for the business. And towards that, if it takes investments into it, we are committed to make those investments.
Got it. If I can ask on Butterfly?
See, on Butterfly, the good news is we have expanded margins out there. This is largely on account of two things. Shantanu talked about premiumization. We have seen this in across categories. For example, the steel cookers have started to pick up as compared to aluminium, so that's one positive sign. We are seeing that in cooktops, we are seeing that in mixer grinders. This coupled with the cost initiatives that we have taken, what we have in Crompton, the project is very extended to Butterfly, has also helped us to drive gross margin improvements out there. There also, considering our learning out here, we would not be curbing on investments behind brand. So already Butterfly is tracking at about say 5.5% on A&P spends. We would only try to keep that at the same level or increase as we try to grow. Now, the most important lever for Butterfly is the power of one that we talked about. While Butterfly is a strong brand in South led by Tamil Nadu, we believe there are strengths that Crompton can provide to Butterfly and make it a pan-India brand over a period of time. And this is riding on the distribution leverage that Crompton has got. We are starting with few pilot markets in northern India and in western India. A couple of markets is what we are starting with. Once we establish that, we think that can expand the growth opportunities for Butterfly beyond where it is today. And the channel optimization is largely done in terms of e-commerce and retail. We have seen good, strong double-digit growth in retail. And in terms of non-core channels also, we are clearly de-risking. So if you look at it pre-acquisition, Butterfly was largely a government e-commerce-led business delivering about 5 to 7% EBITDA. Today we have rationalized it to become a 25% e-commerce business and drive business through retail along with e-commerce. We have also on the process of rationalizing a large part is completed in terms of non-core channels, and now is the time to invest behind that brand and take it national.
Got it. Thanks, and I'll get back in the queue with more questions. Thank you.
Thank you, Renu. We have the next question from Achal Lohade, JM Financial. Achal, please go ahead and ask your question.
If you could help us understand in FY23, what has been the mix in terms of fans, pumps, water heaters, and air coolers? Why I'm asking this is, given the different challenges we are facing in different segments, if we can understand how the revenue mix and what kind of margins we've had in FY23, I think that would be of great help.
About share the data at a category level margin or category level share, but what I can give you is a broad perspective. We are fans led in ECD. A large part of our portfolio comes through fans, followed by pumps, and probably in about say a year or two, we will see our appliances business also reaching there. So it's fast growing in appliances led by SDA and LDA led through water heaters and geysers.
Is it possible to get some similar in the similar fashion the margin? Like is it the case that pumps is highest margin compared to fans or other way around?
ECD is about the same.
Yeah. Platform margin for ECD at a category level is almost the same.
Apart from, of course, the large kitchen appliances where it is a best.
Yeah, it's still interesting. Yeah.
Understood.